Press the bell icon on YouTube and don't miss another update.
Hi, welcome to a new episode of Economics. The slowdown in the economy is not news. Neither is the slowdown in the sales of passenger vehicles and commercial vehicles. But how bad this slowdown in the automobile sector is beginning to get alarming. The latest figures show that automobile sales have fallen for the 9th month in a row. And this is supposed to be the worst such slowdown in almost 2 decades. What seems to be at the core of this problem? Because the slowdown also has extended to the infrastructure sector, to real estate, and the financial system as a whole. To explain this and get to the bottom of this slowdown, I have Professor Ela Patnaik with me, who's written about this in her latest column on Economics. Hi Ela. You talked about the slowdown as not so unexpected in the sense that you give a sense that this was sort of coming. And this is based in the financial system we seem to be operating in. Can you just elaborate on that? Because the general feeling is this is getting really bad now.
So, the point I'm trying to make is that finance is really the lubricant of the economy. And when the financial sector breaks down, or when there are troubles in the financial sector, you're going to have trouble in the real economy. The latest example of that is this slowdown in the automobile sector. And the slowdown is so much that there's been about 36% decline in car sales in July, two-wheelers by another 16%, commercial vehicles another 25%. So what's going on? Primarily that after the IL&FS crisis, the non-bank financial intermediaries who used to be able to borrow from banks, from mutual funds and so on, have not been able to borrow. When they can't borrow, they can't on-lend. And there are important parts of the financial sector, of the automobile sector, like dealers and consumers who were dependent on them for financing. So, we had a story in ThePrint by Ramya just after Diwali, where she talked about how inventories had built up far beyond normal inventories with dealers. And what was really happening was that normally when people would hold like 15 days of inventories, they were holding 4 months of inventories. Beyond a point, it's not affordable, because after all, they are borrowing to be able to buy those cars before they can sell them further. The phenomena of a breakdown in the financial sector, or a crisis in the financial sector leading to problems in the real economy, is not new. We saw that with the real estate sector as well. When they started hitting limits, banks have limits for how much they can lend to each sector, then the real estate sector started getting into trouble. Again, because they were financing the consumers, whether it was banks or to some extent NBFCs, that they were financing consumers, and they were also financing the builders. So again, we saw trouble, mainly because the financial sector has not been able to provide adequate finance. I think the biggest story that we've had of this kind has been in the run-up to the 2008 crisis, when we encouraged large infrastructure projects. We had these
That was the global
PPP
slowdown.
projects.
That was the global slowdown.
Yeah, but the PPP projects, where were they going to get money from? So they got money from banking, and India has a largely bank-dominated financial system. So public sector banks would be asked to lend to a number of infrastructure projects. It doesn't really suit a banking model, because they are borrowing short term, and then when there are delays in project implementation, as happened because of the lot of policy paralysis, environmental clearances and so on, these projects became non-performing assets. So infrastructure companies who were, a handful of large infrastructure companies were eligible for bidding for large infrastructure projects. Those companies, almost all of them, got into trouble because they were not able to borrow more. So infrastructure financing saw a huge slowdown, and as a result, infrastructure saw a huge slowdown. You see, public investment, and government doesn't have that much money to build the kind of infrastructure that India needs. So what we've seen repeatedly is that when there is a problem in the financial sector, that leads to problems in the real economy.
And the response of the government has been to, or even the financial regulators has been to just apply band-aids every time there is a problem?
Yeah, so the biggest example we see again is the infrastructure sector. What was done was regulatory forbearance. I'm using the jargon regulatory forbearance. You'll often hear it in this context, or we
What
may
does that
call
mean?
it
No,
kicking
for
the
the
can.
for the layperson, what does that mean?
So it's kicking the can down the road. I tell you, look, okay, you can't repay me now. You can pay me later. Okay, I restructure your loans. So that's one part of what was done. Then banks were facing huge losses, so banks were recapitalized. Interest rates were brought down. Liquidity was increased. But you solve a small problem, you try that, you tell banks, oh, we've cut interest rates, so now you should go cut interest rates, your lending rates as well, and we see hardly that transmission happen. In the real, if I go back, then the problem is that in 91 we liberalized the industrial sector. We removed licenses, imports, industrial licenses. We did not liberalize the banking sector to the same extent. We did a bit, but not to the same extent. And the result is that every 10 years or every 7 years, if the economy is growing at 10%, then every 7 years, if it's going at 7%, then every 10 years, real GDP is doubling. Our finance has not kept pace. A very important role of finance is resource allocation. By that I mean that the financial sector gives resources to the most productive projects. What we are doing is, if we are holding the reins of a tight leash on the financial sector through public sector banks, that competitive financial sector which allocates resources to the most productive sector is not happening. There were bills introduced for a resolution corporation, so that then you could have a more competitive banking system, you could give private bank licenses. Attempts were made also to improve governance in public sector banks. Now, none of that has really happened. There was an attempt to set up a public debt management agency that would help deepen the bond market. You don't have much of a bond market. You remain with a public sector dominated banking system. And then with the small things that no doubt they'll help, the bit of credit growth, a bit of more liquidity, recapitalizing banks. Of course, those will help, but they don't solve the fundamental problem.
The fundamental problem, it seems, is known, which is again financial sector reforms and deep reforms. But what seems to be the problem there? Because if the problem is known, is it because the governments want to keep a tight leash on money, as you say in your piece, or is it the inability of governments to realize what needs to be done?
See, there have been a large number of committee reports on this, expert committee reports on financial sector reforms. So, and the latest one, the biggest one, was the Financial Sector Legislative Reforms Commission, which said that you need legislative changes for regulation to improve. So, you need to set up a PDMA, the Debt Management Office, you need a public debt management, you need a Financial Resolution and Deposit Insurance Corporation, you need a statutory Financial Stability and Development Council, and a number of others. So the blueprint is on the table. Maybe the first time it was not clear what disruptions it would cause, whether the government had the numbers and the time horizon. Now, you see, it's important they have to do the reforms now to be able to reap the benefits of those reforms 2 to 3 years down the line. So they need to accompany these short-term band-aid measures that are being done.
Is there a political cost to it, Ila? Because governments are always scared of how maybe bank employees will react, bank unions will react, if there is going to be privatization of public sector banks, or you want to shut down bad banks. Is that political cost? Is political cost the question? Although you talk also about the fact that this government has a strong mandate and it's there for another 4.5 years, 5 years almost. So is it a question of political cost?
You see, you have to manage those political costs. So let's say, as you said, privatize public sector banks. I'm saying if you can't privatize public sector banks because of the political costs, what you can do perhaps is the aviation or the telecom model, which is you allow private players to come in. You know, and you set up the ecosystem so that consumers don't get ripped off.
Which
so
they have done. Private banks are.
Very 2 licenses in a decade. Are they satisfying the needs of the Indian economy? Are we still going after public sector banks and telling them, please lend more, lend more, lend more, open deposits, open deposits? You know, each of these mandates means that the banking system is not competitive enough. Okay, so you actually need to take steps to make it competitive, which you, if you cannot do privatization, okay, make those banks well governed to the extent possible, while at the same time allow entry of
More private
banks. Because you do need to give the economy the lubricant to function, and that's what's important. And it's not just, okay, a bit of 8% credit growth and an 11% credit growth for a short while. You'll run up against the next problem very soon if this happens.
But we haven't, it doesn't mean that there have been no problems with private banks either. Even there have been some issues with some of the private banks. They have, been very, loose with their lending policies.
Absolutely.
They have run into trouble. There have been private banks which have been taken over and merged.
Yeah, so the regulator who regulates both public sector banks and private sector banks, and both have trouble, and has been doing regulatory forbearance for both public sector banks and private sector banks, does need to improve its functioning. I mean, there again in the FSLRC, the Financial Sector Legislative Reforms Commission report, you will read that there are a number of things that need to be done to improve the way regulation is done by the Reserve Bank of India. That banking regulation is weak, and that banking regulation needs to improve. And what are the powers that are given to the RBI? What are the roles and obligations of a regulator? Certainly need to improve. I mean, what we are, working with is a system, is a regulatory system that was suitable for public sector banks in the 50s. And it's been many decades, and we do need to understand that this economy needs a more competitive and dynamic financial sector.
Thanks, Sheila. I think the way to look at this cloud is there is a silver lining, which is that these problems and issues have come so early in the second term of the Modi government, and probably the government has the time to address these if it has the political will to do it. We'll wait and watch how that goes. Thanks for watching this episode of Economics. We'll be back with another one next week. Thank you.